Welcome to the second in a series of retirement webinars. My name is Bob Christophel. I serve as the manager of benefits education at Wespath Benefits and Investments. With me today is Frank O'Brien, benefits educator. Hello, Frank.
Up.
And also working diligently behind the scenes is Sheryl Hatcher, who's part of the benefit education team and serves as our senior benefit plan specialist and webinar host. I want to congratulate you on your upcoming retirement and thank you for your service and the good things that you do and for your ministry. This webinar will be recorded and available for future viewing. We will have additional webinars coming. Again, this is the second in a series of 6 retirement webinars. If you have any questions as we go through the material, please note in the Go to Webinar toolbox a question functionality. You can submit those questions and I'll be presenting the first half. Frank will be watching the question box for your questions that come in. We have a very large group today. We will attempt to get to all your questions while we are live, but we'll certainly follow up with you if we don't get to any questions. And then in the second half, I'll be doing the same. I'll be looking at the questions while Frank is presenting. So let's get started. We certainly have a lot of information to cover with you. We're going to begin with just reviewing the 2022 retirement process. What are the steps along the way? What you should be doing? Some of you might have taken some of these steps. Hopefully you have already. And then we'll spend a lot of time talking about the Wespath retirement plans. Where will income come from? How will it replace your paycheck? When can you commence those different types of benefits? What choices will you have available? We'll begin by looking at the lifetime income options, sometimes referred to as defined benefit or pension options. Those last your lifetime. We'll talk about your annuity choices, okay? Different annuity choices that last your lifetime. We'll also talk about the cost of living adjustment, which is an annual increase in those lifetime benefits. After that, Frank will review the account balance options. Some of these plans will continue to be an account balance. There's different ways and different times that you can draw from those accounts. Frank will also talk about life stage retirement income as a really important service that is improving come April. Some additional optional features coming to life stage, which I think are real exciting. We'll share that information with you. We'll go over a housing allowance exclusion, a couple examples, and that really is just a very important tax break for retired clergy. Frank will walk you through an example and talk about some of the things that you want to keep track of in your retired status with the annual conference. And then lastly, we'll review some resources that are available to you. Okay, there is plenty of help along the way. We'll mention a retirement team that we have at Wespath. You have access to the benefit education team that I lead, including individual one-on-one consultations, plus the resources available at your annual conference. So let's get started by looking at the road to retirement, the retirement process. Many of you are kind of in the home stretch of that road and will be retiring this coming July 1st. The process very much this year, as in previous years, will go through benefit access. That's the portal. That's the website where you need to go in and make your elections. If you have not registered yet for benefit access, please do so. We've made the registration process easy and even more secure. It is just something that I would encourage you to do soon as follow-up to this retirement webinar. At some point, and many of you have done this already, but you've gone into benefit access and you made your elections. Those are simply just sitting there, waiting for time to pass, waiting for the calendar to move forward to the close of business June 30th. So please make those elections no later than Thursday, June 30th, 3 p.m. Central Time. But please don't wait until the afternoon of June 30th to do this. Things happen. You could have an internet outage, a power outage, or an emergency comes up. You can make those elections in March, you can make them in April, you can make them in early May. And if you change your mind, you still have the ability, and Frank will demonstrate this later, to go in and cancel those pending actions. Along the way, here is the phone number for the Wespath retirement team. These are resources dedicated to each year's retiring class. Now, there's different types of retirement as outlined in the Book of Discipline. Some of you, probably a lot of you, are looking at a normal retirement, and that just means you've reached the age of 65 or 40 years of service, not end, but or 40 years of service. That is considered a normal retirement. Early retirement, I know I've done some consultations recently with clergy looking for early retirement. That means you've reached the age of 62 or 30 years of service. Mandatory retirement is when you reach the age of 72. And then the fourth one, which I've seen a few of them this year, is a 20-year retirement, where the clergy person has served for 20 years, separated from the denomination, and has come back as early as age 62 to collect those benefits. So what do you need to do if you're retiring this year? It is a good idea to verify all of your personal information on benefits access. Also verify your spouse's information is there and is correct. Now, why, you may ask? Well, your spouse is entitled to receive survivor benefits from these plans that we will discuss. So we want to make sure that that information is in there and is accurate. Also, take a look at your clergy service record. Now, why is that important? Wespath relies on the information in that clergy service record to calculate some of your benefits. And we'll see that when we talk about the clergy retirement security program, the defined benefit component specifically. That's why it becomes so important to look at those clergy service records that can be found on benefit access, and then notify your annual conference if there's any discrepancies or information that is not correct. I'm glad you asked that question. And Frank indicated some people are asking questions already, which is great to see. Continue to use that question functionality. You also want to take a look at your life stage investment management profile. Many of our participants have utilized life stage investment management throughout their careers. And that's something that you can continue to use in your retired status, but take a look at that profile. Take a look at the commencement date. Take a look at your risk tolerance, conservative, moderate, aggressive. And if that has changed, update those profiles. Some of you might not be retiring this July 1st. You want to use the benefit projection tool on benefit access to run a projection at a future date and time to see what income from these plans will look like, utilizing assumptions that you have entered yourself. So that's a real important tool. All of these things that we're discussing, where do you do this? Well, that's on benefit access. We have updated benefit access. It also contains your health and well-being information. Okay, this is where you can run projections, utilize the retirement readiness tool, examine those clergy service records, update beneficiary designations. Make sure that your primary and secondary or contingent beneficiaries are accurate and up to date. And this is also where you would view and update, if necessary, your life stage profile. Now, a real important concern for retirees is, what about retiree health benefits? Obviously, this is really important. Please check in with your annual conference on retiree health benefits. Let's go through this checklist. Likely you've notified your Board of Ordained Ministry already if you're retiring this July 1st. You've notified the bishop, your cabinet, and then make a call to EY. Frank is going to talk a little bit about EY later on. This is an important financial planning service that you have available to you, and many of you will also be eligible for EY services in your retired status. You know, some calls going into EY this type of year typically are around housing, What is the best way to secure a down payment for housing? What is the amount that I actually can afford in housing based upon my income? We did provide you with what I really like, a new communication piece, which is a checklist for your retirement and covers a lot of the items that I just went through. If you haven't seen this or don't have it handy, it is one of 5 attachments on the GoToWebinar toolbar. So if you go in there, you can click and download and print this important checklist. Really takes you through the process. If you go through these steps, it will really help you. And now finally, yes, finally we can talk about money, we can talk about income, how you're going to replace that paycheck that will go away, where and when income will come from these plans. So let's start with the Wespath retirement plans. You might have other sources of income available to you. Some of you, your spouse might continue to work. You might have personal savings, investments, Social Security at some point. This is a big picture look at your Wespath retirement plans. And those of you that have been in ministry for a long time, well, you know this. You know these plans have changed. You know these plans have evolved. I'm going to begin by looking at the Clergy Retirement Security Program. A lot of our participants call that plan CRISP, and it's an important plan. Prior to CRSP, you existed under the MPP or Ministerial Pension Plan from 1982 all the way through the end of 2006. And for those that go back further in ministry, what we now refer to as the pre-82 plan, then it's called the Minister's Reserve Pension Fund. So you can see these plans have changed. They've evolved over time, often due to an action at General Conference. Now, CRSP is just such an interesting plan. You see 2 boxes here, and that really just represents 2 different periods of service, 2 different formulas, which we'll look at to do the calculation. But what makes, I think, CRSP just such an interesting plan, yes, it's the plan design. Okay, it truly is a hybrid. It gives you the advantages of a defined benefit, a lifetime of income, a monthly direct deposit that you can't outlive, and also, if elected, will continue uninterrupted to your surviving spouse. So you have that security of the defined benefit, but you also have that flexibility and that control of an account balance. The account balance, well, that's been appearing on your quarterly statements, but the monthly defined benefit plan, the pension, as a lot of our participants call it, that is a formula, does not appear on your quarterly statements, and is not impacted by any market volatility or market fluctuations. More on those 2 components in a moment. The Ministerial Pension Plan, a little bit similar in plan design. 65%, and it is a balance right now, becomes this lifetime annuity, lasting as long as you do, and if elected, continuing to your surviving spouse. 35% of that balance, however, does continue to be an account balance. The pre-82 plan is also a monthly benefit, and the amount paid to the survivor is set by each annual conference. And I'll give you some examples of typical survivor benefits set by annual conferences when we cover the Minister's Reserve Pension Fund. But wait, there's still one more plan to add to the mix. CRSP, right now, that's the mandatory plan for eligible clergy. But there's a voluntary plan, which is available to clergy as well as lay participants like myself, called, some folks call it UMPIP or UMPIP. Officially, it's the United Methodist Personal Investment Plan, kind of operating independently, but certainly I think a very important plan. I have seen this plan make a difference in a lot of our retirees' monthly income. So when you put them all together, yes, certainly it's very colorful. You have the current plan, mandatory plan, the CRSP, before that MPP, before that pre-82, and kind of operating off to the side independently is that voluntary plan. So let's look at first your lifetime income options. Now, I mentioned the hybrid part or plan design of the Clergy Retirement Security Program, CRIS. We're going to focus first on the left-hand side, the DB, the defined benefit, that lifetime of income. And the reason I like to look at that first, it is more complicated. Okay, there's a little bit more involved. You're going to have to make some really important decisions between now and June 30th. And these decisions you can't revoke once you're set up on the pension payroll. If you made those elections today and woke up a month from now and said, I've made a mistake, you can cancel that pending action. But once June 30th comes and goes, you are locked in to those decisions. The defined benefit, as I mentioned, is not a balance. And sometimes I get asked, Bob, I have my statement, I don't see it. Where is it? I just explain it's not a balance. It's a formula. Well, Bob, is that a good thing or a bad thing? Well, I think it's a good thing for a couple of reasons. Number one, I mentioned not impacted by market volatility. Okay, the formula has not changed if the market is up or the market is down. And another real important thing, it's a lifetime of income. You can't outlive your defined benefit plan. Let's look further at the formula. It looks worse than it is, but it's really very easy math. We're going to be multiplying three factors together. The first factor we call the DAC, denominational average compensation, multiplied either by 1.25% or 1% for two different periods of service. And then we look at the years and months. Everything counts during that specific period of time. The first component is the DAC. This is the average plan compensation of clergy throughout the denomination, but only in that average, we're looking at full-time appointments. And what we have seen, and when you run a benefit projection, what it assumes is growth in the DAC. We calculate this 2 years in advance, so we know what it's going to be for those retiring this July 1st. And we also have calculated it, and you'll see these numbers are going up for those retiring next season, July 1st of 2023. Now, the factor that we use for the first period, and that's why we had those two boxes when we looked at all the plans together. The factor used for the first period of service, January 1, 07 through the end of 2013, is 1.25%. This changed for the second period of service because of legislation at the General Conference of 2012. The factor was reduced to 1% to make these plans longer term and sustainable. So you have two different factors that will be applied. Now, the credited service. If you served a full-time appointment from January 1, 07 through the end of 2013, we'll use the full 7 years. Let's look at a calculation for the first period of service. Again, these are the three factors we're multiplying together, the DAC, 1.25%, and in this example, we're going to assume 7 years of full-time service. So it's really just very easy math. Multiplying the DAC times the factor times 7, we get an annual benefit of $6,612 in this example. Now, pension plans like this, they are not paid to you annually once a year. No, this is intended to be income replacing the paycheck that has gone away. So we'll simply divide that number by 12, and that equals $551 per month. But our work is not done there. That's just the first period of service. The second period of service, covering January 1, 2014 through the end of June 2022, if you've served full-time, that would be an additional 8.5 or 8 years, 6 months, 8.5 years of credited service. The math doesn't change though. It's the same calculation. multiplying the DAC, but now you using 1% and increasing the years for that second period to 8.5, coming out with $6,423 annually. Again, we divide by 12 to get a monthly benefit, and then we just need to look at the two numbers and add them together. And that's what we'll do in this example. $1,086 per month is your benefit. And you might be thinking, well, that's not what my projection says. That's not what I'm showing here. There are decisions that you make that will impact that amount of your benefit. And I'm going to walk you through those decisions that will impact the amount. The surviving spouse benefit, the cost of living adjustment that you choose. This is important. Obviously, we're all aware of the current state of inflation. You've all been around long enough to know that's not always been the case. Sometimes we've had periods of high inflation, moderate inflation, or low inflation. The minimum COLA for CRSP defined benefit is 2%, but you'll also have other choices like 3%, 4%, even 5%. When you go into benefit access, you'll see that the default 2% will be pre-populated, but it's nice to see the impact of a higher COLA. A higher COLA will bring down your initial monthly benefit. And also, if you're considering, we mentioned early retirement, age 62 or 30 years of service, that will impact the amount because there are reduction factors. And I'll just give you a quick example. As I mentioned, I have talked to several participants this season that are looking at early retirement. What we do is we need to reduce your benefit. You might ask, well, why are we reducing the benefit for early retirement? Well, the theory is you'll be getting the benefit for a longer period of time, so reduction factors are applied. And there's different degrees of early retirement. You could be 1 month early and it's not going to have a significant impact. You could be a full 3 years early. That would have a greater impact on your monthly benefit. In this example, the clergy person is retiring 2 years early. They are age 63, and it's very important to mention they don't have the 40 years of service. If they had the 40 years of service, there would be no reduction factors applied. So in this example, it's 2 years early, 0.5% per month, 6% per year is the reduction. So we're going to subtract $130 a month and bring that benefit down to $956 per month. So that is the impact of an early retirement utilizing those reduction factors. So now we can look at the defined contribution component of CRSP. Mentioned that this is a hybrid plan. We covered the lifetime benefit on the right. That defined contribution account balance will continue to be invested in your retired status. You can, if you have been or want to, self-manage that account. You can determine what investment funds it will be in. You can use life stage investment management that can continue uninterrupted in your retirement, but it is available to you as a cash distribution. You could take it all out. This is your money. But you want to look at this like the account balances are intended to last for a while. You can also use life stage retirement income to help calculate how much you can take out. A lot of our participants will simply roll it over. They'll consolidate their account balances into the United Methodist Personal Investment Plan, or you can roll it over outside of Wespath to another retirement plan. You have flexibility. You don't need to do anything. Let's say you're looking at a normal retirement, age 65 this July 1st, and you've made the elections for the defined benefit plan. You don't need to do anything with the defined contribution plan, and that can continue up until you reach the age of 72. That's when, and Frank will talk more about this, required minimum distributions. The government has lost its patience. they want you to start taking something out. For many, many, many years, that age used to be 70 and a half. Back at the end of 2019, they changed that, and now it's you can wait until 72 to take out those distributions. Any remaining account balances, whether it's your UMPIP, CRSP defined contribution, the 35% of MPP, which is not annuitized, any remaining balances upon your passing away would not go to Wespath or the annual conference. They will only go to your designated beneficiaries. And that's why I had mentioned earlier that it's important to maintain those proper beneficiary designations while you're active, but also while you're in your retired status. So let's jump ahead to the next plan. You see the arrow is pointing at the Ministerial Pension Plan, MPP, which right now is an account balance. Okay, it does appear on your quarterly statements. It has to be managed by Life Stage Investment Management. 65% becomes at some point a lifetime annuity. So 65% of that balance goes away, becomes a lifetime annuity for you, and if elected, continuing to your surviving spouse. What about the rest though? That's only 65%. Well, 35% continues. It remains an account balance, and you have a lot of flexibility and control of what you do with that 35% balance. So when you put them all together, on the left, that's a lifetime benefit. 6 different options, which I'm going to walk you through. And I want you to fully understand all 6 options, not just the one that you're choosing, but the 5 that you are not choosing, because you're not going to be able to make a change once you're on pension, payroll, retired status. You're also going to have a choice for a cost of living. So both the CRSP DB and that lifetime 65% annuity both have annual increases. So that's just so important. And the 35%, I think that gives you some flexibility, some control, different options. You might not need that money right away, or every retirement is different. No two are exactly the same. Some participants will need that money right away for different purposes. So let's review this slowly. Let's go through the annuity options. Again, you're going to have 6 different choices, and none of those are not lifetime. So there's not like one that you could pick and say, oh no, I made a mistake. That was the one that doesn't last my lifetime. They all do. Okay. An annuity, for purposes of these plans, is really just a series of payments, and it's not, a physical check. These payments will be made via direct deposit. So it's a lifetime annuity, and if elected at the time of your retirement, will continue to your surviving spouse. So you can say, wow, Bob, these annuities can last 2 people's lifetime. Yes. As a matter of fact, if you have a spouse, okay, they are entitled to receive a survivor benefit unless they have agreed, understand, and waived their right to receive such a survivor benefit. Now, there might be circumstances when that is a good financial, prudent decision. You can have conversations about that with your financial planner, or you can pick up the phone and call EY Financial Planning Services. So again, all of these annuity options provide you with this lifetime of income, that financial security, just knowing that one day, one birthday, one year, one anniversary, your payments don't stop. They last as long as you do. And as mentioned, is going to continue to the surviving spouse. So I want to give you an example of the annuity types. The example applies to both CRSP defined benefit as well as MPP. The example, the numbers are no one's exact benefit. This is just an example of a clergy person who is 65, normal retirement, and they have a balance in MPP of about $400,000. Your actual numbers are likely to be different. The first three annuity types, we'll call them, are called sometimes joint and survivor, sometimes life and survivor annuities, payable for 2 lifetimes. You'll see 2 different columns with dollar amounts. We don't pay out both columns at the same time. The column in the middle is paid out first, payable to you, the retired participant. And you'll see 3 different dollar amounts. The highest dollar amount is $913 in this example, and that represents a life and 70% annuity type. That means that you receive 913, and the example here has a 2% COLA. You pass away, your spouse will receive 70%. So life and then a percentage to the surviving spouse. So you see 639, and you might be thinking, well, Bob, that's not going to be enough. Let me also look at the life and 85% numbers. And you'll notice quickly 2 things happen. The amount payable to you decreases, but the amount payable to the contingent annuitant, often the spouse, goes up more to 85% of the amount that was payable to you, 754. And you might be thinking, well, that's not going to be enough. Let me also look at the number behind the life and 100%. And you'll see that that further drops down to 862. The same number, 100%, continues to your contingent annuitant, the surviving spouse. The next 3 we call sometimes SLAs, or single life annuity options. And you'll notice right away, wow, Bob, I like these numbers. These numbers are higher. Why? Why are they higher? Well, they're only covering one person's lifetime, and we just don't know how long that lifetime is going to be. So 3 different options here. You know, the joint and survivor, life and survivor annuity is really the standard form of payment for a married clergy person. These are optional forms of payment for a married clergy person, but most likely the standard form of payment for a single clergy person. You notice these numbers are bigger. Let's look at the single life only. In this example, $1,061 a month. Clergy person chooses that, and they live 35 years in retirement. That's great. They got payments for the 35 years. But what if a single clergy person chose the single life annuity option and in 6 months they passed away? That's not good. Payments would stop after 6 months. There are 2 additional, I like to call them guaranteed term. We call them 5-year certain, 10-year certain, and that means that we guarantee payments will be made for at least 5 years or at least 10 years. You know, let me give you an example. Clergy person says, let me look at the life with 5-year certain. They could get 106.1. It drops a little bit to 1,056. They choose the 5-year option. They live 30 years in retirement. Again, this is a lifetime benefit. Payments stop upon their death. The term, the 5-year term, is up. Let's say they want to guarantee those payments for an extended period of time, a 10-year certain option. You can see that the amount payable to you again decreases, but now you know that payments will go to someone, hopefully you, for at least 10 years. So let's say you pick that 10-year option and you pass away after 7 years. The term is not up. There's 3 years left. Who will get that? Who will get those payments? The person that you have designated. If they have predeceased you, you can always name someone else, but someone will get payments until the 10-year term is complete. So a lot to think about with those options. And then another really important decision is, you know, what is the cost of living adjustment, or the COLA? Again, this COLA is an annual increase in your payment. It helps to keep up with the rate of inflation. You know, having a fixed amount of money for someone who's retired is not a good thing. What makes MPP special, different, is that a 0% COLA is also available. The default, when you go into benefit access, just like CRSP, is going to be 2%. You can also choose a higher COLA, 3, 4, or even 5%. Now, you might be thinking, well, Bob, why wouldn't everybody just choose the 5% COLA? Doesn't that sound good, a 5% annual increase? Yeah, it sounds good, but the COLA you choose is going to impact your initial benefit amount right out of the starting gate. I have a good illustration of, and these numbers don't matter, but it's the concept that really matters. The first one is looking at your default COLA, a 2% COLA, but let's look at some of the other COLAs in this example. The person is age 65, normal retirement. Now this COLA here, you can see is a significant, that's a 5% COLA. So that means that your monthly benefit right from the start is going to drop down. I encourage you, when you're on benefit access, take a look, put in 5% and see the impact. And sometimes it could be hundreds of dollars a month, but every year you're getting a 5% compounded increase. So at some point, there's going to be a crossover where you actually will end up receiving the highest benefit. Now let's look at some of the other ones. This is the other extreme. A 0% COLA only available for you in MPP. And you can see that the 0% COLA is going to give you a greater benefit. Sometimes I've seen this used as, what's the best way to describe it? A bridge to something else. A bridge maybe to Social Security or some other source of income. So that 0% COLA, which is that red line, yes, you're going to get a greater benefit, but it's going to be flat. You'll start off with the highest benefit, but at some point, this crossover point, you could end up with a lower benefit with longevity. And then we chart the 4%. And to summarize these MPP considerations, you don't need to do anything right away with MPP. And that's easy for me to say. Some participants have told me, well, Bob, I do need this money right now. I can't leave it on account. But let's say you're looking at a normal retirement, age 65. You can wait. At any point, you can start to begin your annuity. That could be at 66, 66 and a half, at age 68, at any point up until the age of 72, then you need to commence. You got to think seriously about the annuity options. Things to consider is, how is your health? How is the health of your spouse? Your age, the age of your spouse. Is your spouse considerably younger, same age, considerably older? What are your thoughts on inflation? What other sources of income do you have available? With MPP, you could take and utilize the 35%, that account balance component right now, and you can wait or defer the 65%, or you could do it the other way around. You could take the 65% annuity right now, July 1, and wait on the 35%. That'll continue to be an account balance. You have, and I see a lot of participants simply do this, they roll over that 35% directly into UMPIP, or for that matter, into another retirement plan. So you have some flexible distribution options with that 35%. You can self-manage it. You tell Wespath what you want. Frank is going to talk a lot about life stage retirement income to help you calculate how much to take out. Now, the last plan I'll cover is another lifetime plan. It's what's referred to now as the pre-82 plan. And for most conferences, we do a calculation 2 different ways. We look at the defined benefit service money, if that's there. We do a calculation, but then we also do a more traditional formula benefit. We'll always give the clergy person the highest of those 2 calculations. Again, this is a lifetime benefit. We'll give you the greatest. We're not going to call you up and say, which one do you want? If we use both methods to calculate the benefit, we'll automatically give you the highest of the 2 calculations. I just have a quick example here of a conference that we do the DBSM and the past service rate calculation. In this example, the annual conference has set a past service rate of $750 per year. The participant has 3 years of pre-82 service, so it's pretty easy math. We multiply 3 times 70/50 to get an annual benefit, simply divide by 12 to get a monthly benefit of about $187 in this example. And then we'll look at that defined benefit service money, what that pre-82 money has grown to, and we'll convert it to an annuity based upon several factors. In this example, that equals $3,750 divided by 12, we get $312 a month. So we have those two numbers. We will always give you the highest of the two numbers, but we will keep an eye on that past service rate to see if it keeps going up. Eventually, at some point, the past service rate might be a greater amount, and then we'll simply notify you and switch you over to the past service rate calculation. If you are single at the time of your retirement and have a pre-82 benefit, it's a single life annuity. No other options. It stops upon your death. If you are married during your Episcopal appointment at the time of your retirement when benefits begin, the surviving spouse percentage is set by each annual conferences. Some are 70, some are 75, others are 85%, or even life and 100%. So check with your annual conference on that. Wespath has that information. So we've covered certainly a lot of information up to this point. We'll take just a pause here. I know Frank has been busy answering questions, which I'll be doing for the second half of the webinar. And then Frank is going to go through the account balance options and really talk about when you can commence those benefits, what are the flexibility. Frank, did you get a lot of questions behind the scenes?
We have several questions. As I'm transitioning over, a couple more have come in. So if you would not mind picking that up there. You are seeing my screen okay?
I do.
And it moved?
It did.
Okay, thank you.
Thank you.
Good morning or afternoon, everyone. My name is Frank O'Brien. I am a benefits educator at Wespath. I am coming to you, just like Bob is, from Long Island, New York. Oh, something just happened here to my screen, so if you just bear with me for a minute. What I'm going to review with you today, amongst other topics, are your account balance options that are available to you, how you can take distributions from these account balances, how, when, and how much, and the options and flexibility available. Just as a matter of recall, Bob went through the Clergy Retirement Security Program. It's a hybrid of two different retirement arrangements. One is the defined contribution account. That defined contribution account has been funded by a 2% required mandatory non-matching contribution. And hopefully all of you have been participating in the UMPIP plan and receiving an additional 1% matching, which gives you a 3% matching contribution into the defined contribution account under the CRSP. Bob also reviewed with you that the MPP also has a couple of things going on. The account balance piece is the 35% of the MPP that you do not annuitize, but that becomes an account balance. You can take it to cash distribution, and again, we'll review several options available to you. But now let's take a few times to talk about the account balance that gets generated in the UMPIP plan, United Methodist Personal Investment Plan. Well, first, what is UMPIP? Well, it is a defined contribution retirement plan. It's technically a 403B plan. You may all be very well aware of that, but in today's parlance, people think of 401k plans. Well, in our world, not-for-profit and church world, it is a 403B plan. The 403B, this particular plan can be set up in such a way to receive additional employer matching contributions, but for today's discussion, we'll just focus in on it being a participant payroll deduction type of contribution, and I'll review with you for recollection purposes the types of accounts that are available in UMPIP. As those accounts are going in, they are being invested in the Wespath family of funds, and you have the option to either self-manage your investments. We have the Wespath funds. You can determine what percentage of each fund you want to use and allocate your retirement assets accordingly, and over time make transfers just as you go through your time with us. Or you can take advantage of Life Stage Investment Management, which is a program where we tailor the investment allocation for you, getting some information about you on the system, and then tailoring that and managing that account balance for you over time. The contribution types that are available, well, we'll talk about the before tax and the Roth I'll mention a little bit the after-tax and the application of after-tax in today's world. Kind of changed once the Roth account came in about 7 years ago. And then we'll speak separately about the rollover contribution. That's an amount that can come from a prior retirement arrangement as a one-time lump sum into the UMPIP. So it's not a by payroll type of deduction. The before tax contribution account is where you determine before taxes how much money you want to get taken from your pay to be put into the UMPIP plan. And then when that is done, the taxes get applied. So SECA, federal taxes, depending upon your state taxes. With the Roth account, that is a contribution account where the tax process is a bit different, but the dollar amount being put into UMPIP is the same. You tell us how much you want in, we get your gross pay for the month, we take all the taxes that are applicable, and then that amount goes into the Roth account. And if the Roth account is a qualified Roth account, then you can receive distributions in retirement tax-free. What's happening is you're getting taxed now and giving the IRS the money now to put into Treasury, and they're saying, well, we can't tax the contribution again, or the pay again, because we've already done that. And any earnings on that, we're going to allow you to take distributions on, because we've already got that tax money into the Treasury. For it to be a qualified account, two things have to happen. You have to be over age 59 and a half, and the first contribution has to be 5 years old or older. So for some of you who may have gotten into the Roth account fairly recently, just be mindful of that 5-year rule as well as the 59-and-a-half-year rule. The after-tax contribution comes into play now more because with the limits that are being provided in these types of plans, if you hit those limits, that after-tax contribution account is still available to you to contribute into. The rollover process to take monies from a prior qualified retirement plan is very straightforward. We accept rollovers from four other 403Bs, 401Ks, 457s, traditional IRAs, anything that is a qualified employer retirement account, you roll that over into the UMPIP. We have a form in place. Actually, Sheryl Hatcher, who is with us today, also manages this process where after you complete the form, we manage that transfer, that rollover from the current holder of those assets to the UMPIP here. It's a non-taxable event to you. This is something to consider as you're going into retirement, where if you have those types of plans, you may want to consolidate everything into the UMPIP to take advantage of the programs and flexibility available to you in UMPIP. We don't think it's putting all your eggs in one basket. It's just retirement part of your overall picture. And we think it's better tended to when it's all together in the UMPIP plan, because that's really where your focus on retirement income is going to be. You do not have to roll over the money before 7/1/2022. You can roll that money in at any time when it maybe makes better sense for you. You have a lot going on. Maybe now is not the time, but you always can. And often we get the question, hey, can my spouse roll over money into UMPIP? And the answer to that is no. It's an individual retirement account in UMPIP. Now, if your spouse is clergy and in UMPIP or otherwise in UMPIP, then the answer to that would be yes. But in general, we don't allow non-participants to roll money into the plan. As I indicated, we're talking about a defined contribution plan. The IRS, through law and regulations, defines the amount that we can contribute on an annual basis. Assuming here everybody is over age 50, this year the amount is $27,000 combined before tax contribution and Roth. It's not one of each, it's combined to $27,000. Again, this is where that after-tax contribution account can come in. If you have the opportunity as a household to max out on those contribution limits, still have a couple of months left in the year, you can put dollars into that after-tax contribution account. The distribution options for retirees, there's several of them. What you will see as you get closer and more involved in actually making your elections, that what we will make easy for you to do is to take that crisp DC account balance and roll it into UMPIP. That MPP 35%, roll it into UMPIP. We think that is a sound recommendation, because now all of that is in UMPIP, and that's where the programs and the flexibility live. You can leave it on account till required minimum distributions come along, and that's the next slide I'm going to review with you. That's the attainment of age 72, but you can let that account grow over time. You can take full lump sum distributions, partial lump sum distributions. And we know many clergy going into retirement are considering buying a primary residence, maybe for the first time, having lived in parsonages. And there may be other reasons why you may want to take a sizable amount of that retirement account and do something productive with it. And there's nothing wrong with that. Everybody's situation is absolutely their situation. We just like to point out a couple of things for you to think about and formulate questions around. If you take out a large amount of the retirement plan, well, that's going to be a taxable event. Now, you do have the housing allowance exclusion, but this could be a sizable amount that's just not going to have the housing allowance have that much impact. Taking it out of the plan, well, now it's not available for you for retirement income purposes and that housing allowance tax advantage later on in retirement. And depending upon the marginal tax bracket that you're in, you could actually end up in a higher tax bracket. So all of your income for that year is taxed at a higher level. So again, no right or wrong, but just trying to help you think through some of the options and some of the questions you can ask to an EY financial planner or your own financial planner as you're getting geared up to make elections. You can do cash installments from the plan. You can self-manage that. You can say, hey, Wespath, I only need $1,500 a month from my account balances, and we will do that for you. You can change that whenever. And I'm going to review with you Life Stage Retirement Income, which is a program that we at Wespath generate and calculate the amount of monthly installments for you throughout your retirement. It's not on this slide, but in ministry, you have a loan program available to you. In retirement, you'll have that same loan program available to you. So say you're going into retirement, you want to go on that big trip, but you need to fix the roof. You can grab maybe $8,000 as a loan, 2% interest on top of that. You pay yourself back, and you can use that money later on as retirement income with the housing allowance exclusion. And you and your spouse pass away, any account balance that is remaining will go to your named designated beneficiaries. We always encourage individuals to make sure that they look at their beneficiaries, not just on benefit access and their Wespath stuff, but anything else you have as a household, life insurance, spouse's retirement arrangements, any other IRA or annuity product that you may have. Just want to look at that. The required minimum distributions, well, there was a change in the age for the required minimum distribution a couple of years ago. With everything that's gone on, people may have not been that aware. It used to be 70 and a half, and now it's age 72. So the way it works is, let's say 2022, you become age 72. You can take your R&D this year because it's a required minimum distribution for you. But with that first year, you're allowed to defer receiving that initial R&D until April 1st of the following year. So that would be April 1st of 2023. If you so choose to do that, just please know that you'll receive your 2022 R&D next year, but you'll also have to process your 2023 R&D next year. So in effect, in 2023, you'd have 2 RMDs. These apply to your contribution accounts. If you leave it on account, you're deferring, you're letting it grow, it has another purpose later on in life or as an inheritance to loved ones. We will work with you to make sure you don't miss this, but you have to start your RMDs. There is a tax penalty of 50% if you do not process an RMD. The way it works is at 12/31 of a given year, we get the market value of that 12/31 account. And then a table is provided to us. And you can see that table in IRS Publication 590 if you're interested. And we apply that table, a percentage, to that account to determine what the required amount is. It starts at about 3.4%, I believe, and it goes up each and every year, but not dramatically, but there's a scale that it will go up. So you just want to, if you have any interest in taking a look at that, you can take a look at IRS Publication 590. It's a dry read, so if you're having trouble sleeping at night, you might want to read that as well. That should pretty much help you get to sleep at that point. When you're taking distributions, when you're setting up your distribution accounts, you direct us as to how you want federal tax withholding to be handled on your distributions. But if you do not actually provide us with that direction, there's an automatic legal default that we have to apply. If you're taking a full or partial distribution, it's a 20% withholding that we will hold. And then if it's an RMD, it'll be the 10%. And you'll get a 1099-R and the appropriate form, tax forms around that, and then you just process that through your taxes to determine if that was the right or wrong amount. But without direction, we will default to those required percentages. We've mentioned a couple of times a program called Life Stage Retirement Income. This is a program that's been with Wespath, I think 10 or 12 years, if I'm remembering correctly. I'm with Wespath about 2.5 years. And this is an optional program that is available to you to help you manage your monthly retirement income over the long haul. And this comes from your defined contribution account balances and is within the UMPIP plan. So it's one of those examples of getting everything together to use a program available to you. You are asking Wespath through Life Stage Retirement Income to derive an amount of monthly installments for you throughout your period of retirement. And we do that, we consider the account balance that you have, your age, your survivor's age, your risk tolerance. Are you, as far as an investment investor, financial investor is concerned, are you conservative, moderate, or an aggressive type of investor? And the goal is to provide monthly payments for you and your survivor through your lifetime. And built into this program, we are also devising a way to provide you with an annual cost of living adjustment. These are your account balances, and they are in the Wespath funds. But in looking at Life Stage Retirement Income, we apply the principles of an annuity, we apply the principles of actuarial mathematics and mortality tables to come up with an amount that we can provide for you going into retirement, and in November of each year, recalculate that amount with the intent of giving you an increase in that next year, and do that over the course of your retirement. I am allowed to say that there's a high probability of success that we will be able to make these payments to you through your retirement. It's not a COLA percentage like Bob reviewed, but it's built into the algorithm that drives Life Stage Retirement Income. One of the things we do is we invest these accounts using Life Stage Investment Management. The programs work in tandem. We know what we're looking to achieve relative to retirement income, and we manage the accounts accordingly. What amount of equity exposure do we want? What amount of fixed income exposure do we want to get growth and continue to make payments over time? If you go into Life Stage Retirement Income, you don't have to have 100% of your account in Life Stage. You can carve that out and maybe hold back 10, 15, up to 20% in an account to the side where you can do other things with as you determine for your wishes, and then use what the remainder in that Life Stage Retirement Income. Now, what's exciting is starting in just several weeks, there are 2 new options that are going to become available to you. And these options are optional and customizable for you. And again, in a few months, a few weeks, we should start seeing some modeling features on benefit access to help all of us through the program and its design features. So what's coming? 2 new optional and customizable features. We have a Social Security bridge and a longevity income protection annuity contract. For those of you who are nearing Social Security, you may be thinking about, do I defer Social Security or not? The Social Security bridge is a way to help you think through the options to or not defer your Social Security. And with the longevity income protection contract, that is a contract that pays out later in retirement, guaranteeing you more streams of guaranteed income through your retirement. And again, there will be a modeling tool available on benefit access in just a matter of weeks. The next couple of slides, I'll go through these words to help us figure out the Social Security bridge and the longevity income protection contract. And then I have a visual graph bar chart to review with you as well to give us a little more underpinning as to how the program is going to work. So the Social Security bridge will supplement your income in your early retirement years by allowing you to defer your Social Security. You may be aware of this, maybe you're not aware of this, but for today's example, it's going to say you're age 67, full retirement age. For each year you defer taking your Social Security until age 70, you get an 8% increase in the amount of Social Security income that you'll receive. So that's a 24% increase for those who wait the full 3 years. So what we're doing with Life Stage Retirement Income is working with you and understanding the amount of your Social Security income. You can defer that, and then we'll build into Life Stage Retirement Income how much we're going to give you for that period to keep you whole, as if you were receiving Social Security. But when you actually start to receive your Social Security, we're then going to level off the amount that's coming out of your account balances through life saved retirement income. Level that off, less is going to come out, more is available to grow over time, and you're receiving your Social Security income. And Social Security does go up over time. The way we design this within Life Stage Investment Management is we know the dollars that we're looking to satisfy the Social Security bridge, and we allocate your accounts accordingly, conservatively, to make sure we can make those continuing income payments. The longevity income protection contract is a deferred annuity contract that you will purchase at the time of your retirement. So as you're hearing about this, learning about this, and thinking about this over the next several months, just know that if you want to take advantage of this feature, you will be purchasing that annuity going into retirement 7/1/22, June 30th, 22. But that deferred annuity will begin to pay when you have attained age 80. By doing so, we feel that we are minimizing the risk of longevity. We're providing a steady stream of retirement income over your lifetime. We're pairing that up with your Social Security. You're going to be receiving that by then. And we're continuing to level off the amount that's coming out of your account balances through life stage retirement income. We believe this enhances your flexibility in the early, mid, and late years of retirement in terms of how you want to receive your retirement income. And again, by certain features or benefits of this program, we do believe we are providing you with some peace of mind. As far as costs are concerned, the annuities are based on group insurance rates, so this is a low-cost option available to you. To kind of visualize that which I just reviewed, again, we're going to say age 67 is full retirement age. Someone's going into retirement. They want to defer their Social Security. They're using their account balance through the Life Stage Retirement Income Program to derive the amount that they're expecting to receive. Upon the attainment of age 70, Social Security now begins, and it kicks in. And it kicks in with that 8, 16, or 24% increase, depending upon the number of years of deferral that you had. Age 70, that's it. And you get that Social Security. And you can see visually we're now reducing the amount that's coming out of your account balances through life stage. And then upon the attainment of age 80, well, you have that Social Security, and again, Social Security will be going up. Then you get that deferred annuity, but that is guaranteed now for you and your spouse throughout the remainder of your retirement years. And again, we are reducing the amount that's coming out of your account balances through life stage, keeping you whole as the way you should be on a monthly cash flow basis, but allowing that money to continue to work for you over the long haul. And again, if there's anything remaining in those account balances on you and your spouse's passing, that would go to your named designated beneficiary. By taking advantage of this program, Life Stage Retirement Income, again, you don't have to use all the features. You can just use one or the other, but we do believe this provides you an opportunity to optimize your retirement income, minimize the effect of market fluctuations over time, because although at first you see that life stage is that first area, after that Social Security is coming in, that's an annuity. That's going to continue with its own COLA. You're reducing the amount of your income, and then later on, that income protection contract comes through, and we're reducing the amount of market exposure more. And then it also minimizes the risk of outliving your funds. In the context of this, recall you are receiving a CRISP DB annuity, an MPP 35% annuity. For those long tenured, you're getting a pre-82 annuity. Then you're getting the ability to have your Social Security, you're going to get that, and then this income protection contract. So all of those pieces working together really minimize the risk of you outliving your retirement funds. Again, shortly there will be advanced modeling tools available to you on Benefit Access. You'll be able to plug and play certain scenarios to understand what it is you're trying to accomplish, what the impact is on future income, but in the short term and in the long term, and see what the best options are available to you. This is certainly something that you have the resources available to you at Wespath, EY Financial Planning Services, one-on-one benefit education consultations with we benefit educators, the retirement team. So you'll have plenty of resources as you think through and model the best option for you and your household. Just in getting prepared to look at this, you should understand what your Social Security income is going to be. So you want to create, if you haven't already, a My Social Security account on SSA.gov. Here you want to give yourself 20 minutes or so, a half an hour or so, because they really do dig down into your life to make sure that you are who you are while you're on their website setting up this account. They will ask you in 1974, which of these 4 blocks did you live on? 1986, which of these 4 cars did you own? So they really go deep into your history to make sure that you are who you are. Life Stage Investment Management Profile, you want to review that with or without Life Stage Retirement Income. You want to review that to make sure it is working the way you want it to, specifically that risk tolerance area. Understand all your sources of retirement income. At the close of the Life Stage Retirement Income section, I was talking about how all these things are working in tandem. Get them all laid out, work with an EY or a financial planner, model that over the long term. Again, you have EY there, you have retirement services, and this program may be something that really has you thinking about, hey, I'm going to roll over that money I was going to wait on, put it in there and get started with some of these programs that I'm hearing about today. You're receiving your retirement income in all kinds of forms, ways, benefits, options that you've chosen, and you still have that housing allowance exclusion available to you. In ministry, you've had the housing allowance in some way, shape, or form over time, I imagine. In retirement, you continue to have that housing allowance tax exclusion, a great tax advantage for clergy. What the IRS has you do is look at 3 numbers. The first number is, well, what was the retirement income that I received from Wespath? And you'll know that because in January of every subsequent year, we will provide to you a tax form 1099-R, R for retirement, that will indicate to you the amount that you received and the amount eligible for exclusion. What is your actual housing expenses? That's that second number. Keep good records. Keep that as high as possible, right? Jot down everything that is available to you, not just mortgage, interest, and property taxes, homeowners insurance, utilities, cleaning products, snow removal, landscaping, all of that. Work with your tax advisor to understand all that you can record and keep receipts on that can apply here. And then for those who own their residence, the fair rental value of that residence in their neighborhood, fully furnished, plus utilities. So the IRS wants you to have a market comparison as to how much you could rent your household for. There's various ways to do that. Many of them are online, but we recommend, and you may already know, a realtor in your town. Go to the realtor in your town, get what they call a comp letter, a comparison letter, put it in your folder every 2 or 3 years, replenish it because rents do go up, and just make sure you have that there. Now you have your 3 numbers. What did you get from Wespath? What's your actual housing? What's the fair rental value of the property? The lowest or least of these 3 numbers is what comes right off the top of your overall household income, and the remainder goes into your tax filing season. One thing to point out here is, and we often get the question, well, what do we have to do to make sure we continue this housing allowance in retirement? Each year, your annual conference, in your annual journal, will have language of some sort, a resolution of some sort in that journal that says, for all our appointed retired clergy in this annual conference, in the next calendar year, whatever income they receive from Wespath will be eligible for the housing allowance tax exclusion. So you don't have to do anything. That is done for you each and every year. Another recommendation, this year's annual journal or that page from the annual journal, just print that off, put that in the file so you know you have that, but there isn't any activity that you need to be concerned about each and every year. Here is a housing allowance exclusion worksheet. I hope many of you have been going on your annual conferences, have been supporting or promoting a retirement webinar. This is a standard form that goes into our retirement kit. And here you can outline those 3 numbers that I just reviewed with you. A simple example would be, hey, what did I get from Wespath as retirement income? $24,000. My actual housing is $20,000. I can rent my home for $21,000. What's the amount that I can exclude in that given calendar year? And the answer to that is $20,000. It is the lowest or the least of those 3 numbers. And again, that $4,000 then goes into your tax filing season, but you have other deductions, other exclusions, and other credits. So it doesn't mean all 4,000 of it's going to necessarily be taxed. On the back of, attach a note to IRS Form 1040. On the back of this form, if you have it or if you get it subsequently, in the 4th paragraph is language that you can provide to your accountant, tax preparer, that they just attach to the 1040. So if anybody's looking at it, they can see that housing allowance applied to your tax return. It's just a good idea to do. This is available to retired clergy, but it's not applicable to surviving spouses unless it is a clergy couple. Once the clergy person is gone, then the housing allowance exclusion starts to go away. And again, refer to the section in the conference journal where your annual conference continues to make that election for you each and every year. Another document that we often review on the one-on-one benefit education consultations, we send out in retirement kits whenever we're doing an annual conference specific retirement or pre-retirement webinar, is the retirement benefit projection. It's not a forecast, it is an estimate. It's an estimate that looks at the day in which we ran the projection. It looks at your service time and will continue to make assumptions as to continuing service. Account growth, MPP, 4% annualized rate of return, CRISP DC, UMPIP, 7% annualized rate of return. If you get one that's several years out, compensation increases, DAC increases. So we go from today to a future date with conservative assumptions to give you a feel, an estimate as to how much you can receive in retirement from your various buckets of assets. We intentionally split this up into various areas. The top part is lifetime income. That is where you'll see the amount of estimated annuity for your CRSP, your MPP, and for those in pre-82, the pre-82 annuity. And then we drop down to that middle area, the account balances, the CRISP DC, the MPP 35%, and your UMPIP. We make assumptions on this page as well. Up in the lifetime income, we assume if you're married, a life and 70% annuity with a 2% COLA. Account balances below, we assume you've taken life stage retirement income as the program to derive installments. Lifetime income for those who are single, we assume a single life only annuity with a 2% COLA. And that last section there is where you can look to see what your income replacement ratio is of your Wespath benefits against your planned compensation. There are other variables that come into play when you're looking at that, but it's good to understand how much your Wespath benefits are replacing that Wespath income the income you're receiving from your employer, and then include other things, Social Security, other income from your spouse, any other income that you're going to derive, maybe prior employment, and all of that. Income replacement ratio, another great topic to have with EY Financial Planning or your own financial planner. As far as the receipt of your retirement income as you head into retirement, well, in general, these will arrive on the first and or second business day of each month. But 7/1/22 or 7/1 of every year is the retirement date. 6/30 we have the cutoff. Then we begin to process everything. I think in this instance we give ourselves an additional day just to make sure it's all reconciled and correct, and then we will transfer that deposit to you. But we also bump into the 4th of July holiday. So for this year, you can expect to receive your initial retirement income stream, be it the annuity or be it from your account balances, on the 7th of July. But thereafter, the first business day of the month, you'll receive your annuity income, and the second or third business day of the month, you will receive your account balance income. So installments from life stage retirement income, or if you're self-managing installments, you'll receive them on the second or third day. As you register or as you go through the election process on benefit access, one of the screens we're going to present to you that you'll fill in is your banking information. Good news there is that you only have to do it once. We save it. We have it for all your other elections. But you give us that information, and we electronically file transfer your deposits to you to that designated bank account. For many, there is also the ability to remain eligible for retiree death benefits. So we have the comprehensive protection plan. There's different types of benefits, welfare benefits in ministry, but the death benefit also continues in retirement. We'll look at the column on the left-hand side. We see retiree, retiree spouse, retiree surviving spouse, retiree child. So you can interchange that a little bit with clergy. So let's say that the retiree, the clergy person, passes away before the spouse. The spouse will receive a benefit of $20,808. The spouse passes away before the retiree receives a benefit of $15,606. The retiree passes away later on, the retiree surviving spouse passes away. That individual's named designated beneficiaries receives the amount that you see there. And in the instance where there is an eligible child who passes away, then either the retiree or the surviving spouse of the retiree will receive an amount of that 8323. This is an amount that does get increased over time, 2%. I think it's at each general conference, but I know we have a proposal in front of general conference to do it each and every year. So you will anyway see that amount go up, if not next year, a couple of years down the road. We've talked about EY Financial Planning Services. That is a great partnership that we have with EY, Ernst & Young. They provide confidential, comprehensive household financial planning services to all of us. And it's at no additional cost. The way the program gets paid for, like pretty much all of our programs, is through the operating expenses of the Wespath funds. You have the Wespath funds, they kick off operating expenses. Those operating expenses pay the overhead of the organization, everything from salaries to pencils. In that is also included EY Financial Planning. So I'm not allowed to say it's free, but it's kind of free because there's no out-of-pocket expense to you. And there's no limit on the number of times, the number of hours that you use them in a given period of time in a given year. They are available to you as you need them. I would say the front-end investment of using EY is your time, because EY is going to want to see not only your Wespath accounts, but everything else that you have as a household. All the income that you're going to receive, any debt obligations that you have. They'll even look at your life insurance policies, any other annuity policies. They'll look at them and they'll let you know what they see, but they will not try to sell you anything else. They will not say, hey, I got a better life insurance policy for you. They will not do that. It's objective advice of what you have and how you can derive income that satisfies the wishes and goals that you and your household have. You have an 800-360-2539 telephonic number that you can call and do a telephonic consultation with them, or go on to wespath.eynavigate.com. You can certainly access all the EY financial planning services already discussed, but there's also a lot of educational resources there. That whole thing about risk tolerance, am I really conservative? Am I aggressive? There's some tools and some information that they can provide for you as you think clearly about some of those issues relating to your financial life. So it's great service there for you. Going into retirement, we talk about it in the macro sense of retirement planning, financial planning, tax efficiency planning, and all of that. So they will help you with that. Estate planning, income planning, how to position your accounts using life stage retirement income in retirement. But you can also talk to them about any financial topic. Both Bob and Todd coincidentally called EY a couple of years ago, didn't even know they were doing it, just to talk about whether I buy a car or I lease a car. I think they both ended up leasing a car. So you can use them for anything like that. Just thinking about a loan that you may want to take, commercial loan, a retail loan you want to take or something like that. You can talk to them about all of that and they will help you. Funding college education for your kids, your grandkids. Again, the topics, as long as it's financial, they can help you with that. The benefit education team provides one-on-one benefit education consultations. Many, hopefully some of you have already taken advantage of you, many have. Please take advantage of this. It's a wonderful program. We really enjoy doing it. That website, that link there, wespath.org/r/consults. You click on that, you type that in, click on that, and then you can set up a 1/2 hour benefit education consultation with myself, Bob, who's on this call, or Todd, who's actually in that picture. It doesn't have to be a one and done type thing. If the 1/2 hour isn't enough, we can always schedule more. Your spouse is invited. Your financial advisor is invited, if you have one, as long as you are there. We'll go through your benefit access records. We'll go through some of the reports that you've heard about. We'll show you, if you'd like, how to make your elections on benefit access. So please take advantage of that program. It's a great program. Going into the pandemic, we were just talking about it. Pandemic came, it became a thing, and it's been successful. And I think each year so far, we've done about 800 of these one-on-one consultations. So another resource available to you if you so choose. So if you're not already registered at Benefit Access, please do. It takes about 10 minutes to do so. Go to wespath.org, www.wespath.org, Benefit Access, click on that and follow the panels after that. Give yourself 10 to 15 minutes. You want to make sure that all your personal and spousal personal information is correct and accurate. Life stage investment management, it's always good to understand what's happening there. If you're self-managed, it's still good to understand where your accounts are at any particular time. Use the tools available on Benefit Access, run your retirement income projections, do some retirement readiness tools, see if there's any gaps in there, work with EY, get a benefit education consultation, and just continue to work through your particular circumstance. We think it might be a better idea to have the one-on-one benefit education consultation before the EY, only now we can help you think through some of the items that's top of your mind, help you formulate the questions for them. We can't give advice and guidance, they can. But again, everybody's themselves. If you'd like to just do EY without that benefit education consultation, please do so. An outline of the resources, the retirement team. It is a group within our general service area that is dedicated to retirees. Certainly this year's retiree class, and then in retirement, there's still an available resource for you. General questions, if the retirement team isn't what you're thinking about, you can go to Participant Solutions, see the phone number there. EY Financial Planning Services that we've talked about. And on your phone, you can download an app that provides you with inquiry-only information about your accounts at Wespath. You can't do transactions on there, but you can look if you have something you want to check real quick in terms of an account balance or something else related to your record on benefit access. So a plethora of resources available to you. I hope you take advantage of them. We thank you very much for your time and your patience with today's webinar. We hope it was informative. We agree and believe that the more you hear, the more you'll get out of it each and every time. As Bob indicated, there are 4 more of these, April 5th and 28th, May 10th and May 18th. And maybe your annual conference has already provided a webinar or is going to provide a webinar. But again, the more you hear it, the more better it is. Can't believe I just said that. But thank you again for your patience and have a wonderful rest of your day. Bob, if you have any closing comments?
I want to thank everybody. We had 100 participants on this webinar, which is just a great number. We recognize that there is demand for these types of webinars. I went through all the questions, cleared the board there, but just want to thank you. And this is just a step along the way. We look forward to meeting you on one-on-one consultations. Frank mentioned all the resources of the retirement team, your annual conference. But again, congratulations on your upcoming retirement. And thank you so much for your service and your ministry. Good day.